Good morning. Welcome to Trading Hour. It's a great Monday morning. The Nifty reclaimed 25,000 as we speak. It's just shy of that. So the Nifty is now hovering with a gain of about 0.6%, 160 points higher. And Sonia, we're exactly 100 points away from that all-time high level of 25,078.
Absolutely. And, so many stocks are moving around, whether you look at different themes, right? I mean, there's IT, there's banks, there's consumption names that are doing pretty well. So I think this is a really, really good-looking market. We've had large buying from domestic institutions as well in the last many days. Global cues have been very, very supportive. So all in all, the market has sort of climbed every wall of worry and now is back with big, big gains under our belt, about 165 points and getting better as we speak. But Alok Agarwal from Alchemy Capital Management joins us now to discuss the market fundamentals and his top sector picks. Alok, good morning and thanks a lot for joining in. This is a market that has had a remarkable move in the last many weeks and months. But your thoughts on which way things are headed now, considering that we have put a big rally behind us, do you think we can build on to these gains?
Hi, good morning. We definitely think we can build on to these gains. Definitely the last 1 year was a remarkable rally on the back of sectors, especially which had not done well for a decade or so. It's good to see participation coming back from other sectors as well. India is in a uniquely positive situation, both on the growth front as well as on the balance sheet strength front. So we do believe that there is more legs to this rally. And we are hopeful and positive on the markets too.
What about IT? If you could just get a bit sector specific now. Now, IT's had a phenomenal run. Since the month of June, we've seen the IT index give a return of nearly 30%. And this is despite earnings not picking up. In fact, if anything, in the June quarter, there were a few earnings downgrade. So this outperformance of Indian IT, which has now been close to about 18 months and particularly accelerated in the last 3 months, is largely because of PE re-rating. So the question is the IT rally justified? Does it make sense to buy in at current levels or valuations are too rich?
You're absolutely right, Zima. The valuations are a little richer, especially on the sector as a whole. The index, the IT index could be trading somewhere around 28 times on a 1 year forward basis. And the estimates for the next 2 years, earnings growth stand close to 10% odd. If we divide the sector into multiple parts, the larger companies are more to do with the IT services. And these are the ones that are having a slower run rate on the growth side. But some of the software companies, some of the companies with products, those on the ER&D space, and as well as on the fintech platform space, some of those are experiencing quite a high bit of growth. So on the lower growth fronts, the higher valuations in our view is not justified. But the other ones which are actually having a higher growth rate, as well as the growth visibility, we are positive on those things.
Okay. What about some of the new age platform companies, some of the consumption plays, some of the travel related stocks, whether it's the hotel names? Indian Hotels is up almost 4%. Indigo is at a fresh high. All of these new themes have done pretty well if you look at it in the last couple of weeks and months. Is there still more to go here?
Yeah, I would tend to believe so. So India as a country, the most structural theme in the country is the consumer discretionary plays. India stands at about $2,500 per capita income and are likely to double this number every 9-10 years. So it's a long runway of growth for the discretionary plays. Sometimes it is the manufacturers of those products. Sometimes it is the way those products or services are delivered. Those which can take the lead and have a very high market share and an increasing market share at a profitable balance sheet and a PL account as well, those are likely to do well. So some of the names that you mentioned, subsectors that you mentioned, they are looking pretty good, especially the ones that can come up the competition and get a thumbs up from the consumers.
So what's the way you have constructed your portfolio now? What is the weightage that you've ascribed to various sectors?
So I would say that we are more positive on the domestic cyclicals. And we have seen that this domestic cyclicals were not participating in the post-GFC era. More or less a full lost decade for them. And they're led by sectors like power, the whole value chain around there, even the real estate sector, the parts of all the capex and manufacturing beneficiaries as well. And consumer discretion, as I mentioned, is the key overweight for a structural basis on India. But some of the sectors that were leading the rally in the past and are experiencing the slowdown in the earnings growth, those are the ones that we are underweight on.
Do you want to name them, your underweight sectors?
So the underweight on private sector banks and as well as the private sector NBFCs, also underweight on the staples and the large IT services names.
Okay, underweight on staples and large IT services names. Okay, got that. Any other themes that you'd be looking at? Because, you know, there are so many themes which are picking up now, which is the focus area of the government as well, whether it's renewable energy, whether it's electric vehicles, whether it is a couple of other new age themes. Defense has been picking up a lot. But of course, some of these are overvalued as well. So anything else that you'd be looking at before we let you go?
In fact, you look at the power sector itself, that's one of the most surprisingly rising ones. And, you know, it's one of the areas that government is focusing on, and rightly so. In India, we are in a unique situation. We experience our peak power demand twice a day. One is during the solar hours, and more importantly, the deficits come in the evening times. And going by the current rates, we are experiencing around 220 gigawatts kind of peak demand in the evenings. If that were to grow at about 7% you know, over the next 5-7 years, we need to add 100 gigawatts plus kind of capacities on a PLF adjusted basis. And that's going to be quite a bit of an uphill task. The government plans to do so, and hence the capex visibility in that segment and the whole value chain beneficiaries are quite a long list. Plus, the sector that is turning around the most is the real estate sector. We are quite positive on that. That's actually showing shades of more of consumer discretionary rather than what was made out of it in the past as a construction sector. So especially the luxury and the premium segments are doing extremely well. Inventory levels at probably all-time lows, and the demand both in volume and pricing doing well actually bodes well for the sector. So power and real estate are more positive. Defense is a long haul, maybe taking a breather after a big rally in the last year or so, but the visibility on the growth side for the next decade looks pretty promising.
How long do you think the real estate upcycle will last?
I would say we are possibly at the beginning of it. You know, It's just a year or so that we have done well. Yes, the sector has done pretty well in the last 12-18 months. But even the Nifty real estate index sector itself is below the peaks that we saw in 2007. So we do see a large amount there. The listed and the larger names are actually gaining market share. The pre-sales numbers are pretty good. And more importantly, you know, an inventory level that used to be hovering at around 44-45 months has come to all-time low of 12 months. So with the introduction of RERA, the introduction of GST net, and then at the same time, consolidation happening and market share being gained by the organized players, all have worked out pretty well over the last few years for the sector. Now, higher disposable income and the demand for larger space areas, especially as a catalyst, which COVID did, all these things are boding well for the sector, and the numbers are pretty strong.
Okay, the numbers are pretty strong. All right, got that. Thanks a lot for joining us. And have a great week, Alok. Thanks for speaking to CNBC TV18. Let's slip into a quick break. Up next, we'll discuss what's buzzing in the commodity markets with Manisha Gupta. Stay with us. Welcome back. The markets are looking pretty good at the moment. There's no denying that. It's come off a little bit from the highs, but nothing alarming. You'd have to say that things are looking quite good, and we're just 100 points away from that all-time highs. But, you know, I just want to point out a couple of movers in terms of individual stocks at all-time highs. A lot of these names, so whether it's a Trent, Interglobe Aviation, TVS Motor, Coal India, Sun Pharma, Apollo Hospitals, all of these stocks, right, sitting at fresh highs this morning, fresh all-time highs rather, and building onto their gains. I mean, the gains today may not look like much, but these are stocks that are at fresh highs. So whether it's Coal India, whether it's Marico, look at Dixon Technology as well, hit a fresh high today. Dixon Technology now, the market cap of the company has now exceeded 81,000 crores. Dixon Technology, so big mover over there, and hit a fresh all-time high today. In the last 1 month, the gains on the stock has been about 20%, so looking pretty good. Couple of others hitting fresh highs: Voltas, Glenmark Pharma, Persistent Systems, Fortis Healthcare, all sitting at fresh highs. But Reema, you're watching NIIT today?
It's locked in an upper circuit of about 20% because last week Ramesh Damani bought 8 lakh shares. This is according to NSE's block deal data. He purchased 8 lakh shares. That's nearly 0.6% equity at 127.5. So the stock rallied on Friday, which is the day of the purchase, and it's continued with a rally today. In 2 days, Friday and today, the stock is up nearly 30%. But Ramesh Damani is not the only notable shareholder. You also have Nippon Small Cap Fund, which is more than 8% stake in the company. You've got Marathon Edge with a 3% holding. Now, if you look at the financials, NIIT Limited used to be one company where they used to do enterprise training and individual, people-related training. Then they split the two businesses into NIIT Limited and NIIT Learning Solutions. So this is a company, NIIT Financials, and those numbers are up for you on your screen. Where the company's revenue growth has been strong. For the last 2 quarters, year-on-year revenue growth has been about 25 to 30%. But margins for the company are very low. In fact, in the quarter gone by, the margins turned negative. Now, when they came out with the numbers and in the conference call, the company said that in Q2, revenue growth will be similar to Q1. That's a 10% quarter-on-quarter revenue growth. But margins may be slightly negative. So they're saying that we could expect low single-digit negative margins, maybe similar to what we saw in Q1 too, though margins will turn positive in Q3 and Q4. And for the full year, they're expecting a top-line growth of 380 to 400 crore rupees with low single-digit margins for the whole year. That's the guidance shared by the company. But today's excitement stems from Ramesh Damani's purchase in the stock, 20% up today and 30% in the last 2 days. But let's now go across to Manisha. She's joining in with a quick update on what's happening in the world of commodities. Manisha.
Well, thank you for that, Reema. I'm looking at currencies now, and with the US Fed Powell cementing hopes of a rate cut in the month of September, we have seen a reaction come in across asset classes, and currencies have seen a bigger chunk of that as well. So when you look at the dollar index itself, we are down at around 100.5, which is the lowest level that you've seen since the month of July in 2023. So it's a 13-month lows in that case. It also has hit a 13-month low versus the euro. If you look at the dollar index as of now, it is down by 3.6% in matter of last 1 month itself. The dollar index also has seen sharp decline when it comes to versus the pound sterling. It's trading at a 2.5-year lows versus the UK currency, and versus the Asian currencies as well, the dollar index has seen a decline. It's trading at almost a 6-year lows versus the Singapore dollar. It's trading at a 5-month lows versus the South Korean won. It also has seen a very sharp decline versus the commodity currencies. So the Canadian dollar at this point in time is trading at a 5-month highs versus the dollar index. Currencies like Australian dollar, New Zealand dollar also have surged versus the dollar index, with the dollar index now trading at around 8-month lows versus a couple of these currencies as well. The markets do believe that the dollar index as of now is oversold. 100 as a very strong psychological level should be giving some support, and the markets could see some opportunity buying from these current levels.
Okay, Manisha, thanks a lot for that. Let's do one thing. Let's take a quick commercial break. When we return, we'll discuss market technicals with Soni Patnaik of JM Financial and also discuss their top trading bets. Stay with us.
Welcome back. On Friday, the entire RP Sanjiv Goenka group held their analyst meet. So the various entities, so whether it's FirstSource, Saregama, CESC, all of them, the top management spoke to analysts, investors, and laid out the growth plans. So let's talk about each of them and what the companies had to tell the investors. So starting with FirstSource, which is the IT company. Well, FirstSource, this is an MK note from which I've picked up. The company outlined the growth strategy that focused on 7 strategic initiatives, which includes simplification of the organizational structure, cross-selling, upselling, particularly in the top 50 growth customers. They said if they execute right, it's possible to have a mid-teen revenue growth and 14% EBITDA margin. That's the aspiration over the next 3 years. For this year, FY25, the company is confident about meeting their guidance of 11.5% to 13.5%, with margins of 11 to 12%. And they also reiterated their long-term guidance of $1 billion of revenue by Q4 of FY26 and expanding margins by 50 to 75 basis points annually from here on. So MK has an ad rating on the stock. Target price is now raised to 330 and they're valuing the stock at 25 times forward multiple. The stock is down today, but remember, it's up 70% year to date. And I think bulk of the gains came in the last 1 month after Shireen had that conversation with Sanjiv Goenka. So the stock has been on a tear. Today, some profit booking, but the management hit all the right notes in the analyst meet.
Okay, big moves coming in on First Source, but CESC is also in focus this morning after the commentary that came in from the Sanjiv Goenka Group Investor Day. Vivek is here with the details. Vivek, over to you.
Well, that's right. So all of the Sanjiv Goenka Group, Rima just spoke about First Source, also had Saregama, and along with them, one of the top, you could actually call it the mainstay of the entire group, was CSC. So CSC largely reiterated what they've been telling investors all along. The key takeaways as far as, this particular investor meet or analyst meet was the fact that the company said that they're looking to increase ROE by 3% from 12% at present to 15% in the future. They're also looking on focusing on pivoting from regulatory government-operated business structure to a self-control model. They also mentioned that demand as far as the distribution arms of the company, which is both Noida as well as Kolkata distribution circles, continues to remain quite robust. They expect cash flow to improve across all of the discoms, and very importantly, something that we had highlighted earlier, the company has started what is essentially known as a fuel and power purchase adjustment surcharges to account for higher input prices. So that's something that's also aiding the recovery as far as the distribution circle is concerned. Very strong commentary coming in from the group, from the company as far as renewable energy foray is concerned. The company plans to go ahead and develop 3.2 gigawatt solar wind hybrid renewable project in the next 3 years, looking to commission 1 gigawatt by the end of this year and 1 gigawatt annually thereafter. Along with that, the company said that they have 4 gigawatt of renewable energy projects in the pipeline, foresee greater than 10 gigawatt of capacity addition in the next 6 years. So very strong renewable energy capacity addition and focusing more on self-regulated business is the key takeaway as far as CSC is concerned.
Okay, thanks a lot for that. Well, Saregama is in focus on the back of its analyst meet. The management has given a revenue growth guidance of 25 to 26% over the next 3 years. Vamakshi is joining in with all the details. Vamakshi, over to you.
Well, absolutely. Like you rightly pointed out, revenue growth guidance X of Caravan of 25 to 26% is expected over the next 3 years. Music licensing is expected to log a 23% CAGR, and this would largely be driven by improvement in margins as well as on account of leadership and scale benefits. The growth in turn would be supported by an investment of nearly 1,000 crores that they would make over the next 3 years in the new music, and this investment will in turn ensure that the company stays relevant going forward. Even the old catalogue continues to see steady growth of 10 to 12% with margins of around 75 to 80%. As far as the video segment is concerned, they said that that this segment is at a relatively nascent stage and is expected to clock a growth rate of almost 25 to 30% over the next 3 years. Margin improvement is also expected given a bigger library as well as scale, and in fact, the company went ahead and said that over the next 12 to 18 months, they're expecting margins at 8 to 10% from this particular segment. As far as Carvaan is concerned, they say that the focus is now on generating higher margins as compared to revenue growth, with the elder generation now becoming accustomed to streaming. The life cycle of the product has now become limited. Overall, they believe that the PBT growth should be slower in the next 6 months as the company ramps up its content acquisition and integrates Pocket Aces. But after this, they're expecting the PBT growth to outpace the revenue growth. So given those factors, MK has maintained their estimates, retained a buy and given a target price of 580 per share.
Thank you very much for that. That's from the top RP, RP Sanjiv Goenka Group companies. But let's talk about the market technicals and where we are headed from here on. Will we make a dash towards our all-time high levels of 25,078? Right now, we're just about 100 points away. Soni Patnaik from JM Financial Services is with us on the show. Soni, is today the day when we go to our all-time high levels? Are you sensing momentum?
Hi, good morning, Reema, Sonia. Thank you so much for having me on the show. Definitely, I think we can see a lot of aggressive put writing happening at 25,000 put option today, and it is just loitering about that level. So, as long as it is holding above the 24,950 mark on intraday basis, there is a possibility that we can test 25,050. Either way, a positional play also looks strong for Nifty. It can test 25,250 to 25,400 levels in the coming days. So one can continue to accumulate these Nifty index, hold for a long with trailing stop loss of 24,800 from current levels, and a positional target of 25,400 can certainly be seen. Mostly it may happen in the next series, the first few trading days of the next series, as this is the monthly expiry. So there could be a bit of a volatility, but certainly no panic as of now, and one can continue to hold the longs for Nifty and for Fin Nifty as well.
Okay, well, thanks a lot for that. Any individual stocks that you're looking at?
Certainly. So the first stock would be from the IT space, which is in clear good momentum today. Naukri is the stock. It has seen very aggressive fresh longs today to the tune of 14%. It has seen a very fresh option chain breakout above 7,500, and it's also a fresh breakout on charts as well. So one can accumulate Naukri at current levels of 75.10 in futures as well. Keep a stop loss of 74.20. A target of 7,600, 7,640 can be seen from current levels. The second pick would be from the financial space, ICICI GI, which is looking for a very strong breakout, which has come above 2,100. It's a good fresh option chain breakout. So one can buy ICICI GI at current levels, keeping a strong small stop loss of 2,090 and a target of 2,130, 2,140.
Thank you very much for that. We will slip into a very short break. But on the other side, we've got a very interesting discussion. Now, everyone's talking about India's ascent in the manufacturing ladder. And increasingly, all the manufacturing-related stocks have also done very well. But can India become as strong as China and become a manufacturing powerhouse of the world? Tanvi Gupta, the economist at UBS Securities, has done this analysis, and she joins in with her thoughts and insights.
Welcome back to Trading Hour on CNBC TV18. Well, brokerage house UBS has written a report discussing India's potential to grow as a manufacturing hub and potentially replacing China as a factory to the world. Tanvi Gupta Jain, the chief economist at UBS Securities, joins us now to discuss the report further. Tanvi, hi, great to see you on CNBC TV18. Thank you so much for joining us. You know, these drawing parallels with China has been something we've been doing for almost a decade now. But where do we stand at the moment? And, what has your analysis been? What's the key takeaway from your report?
Sure. So what we have done is, specifically since the pandemic, or I would say in the past couple of years, economic fortunes and outlook for China and India has been quite divergent. So you would have seen that the China's economic recovery has been weak, especially since the pandemic. Whereas if I look at my India's economic growth, that has been pretty strong so far. And if I look at China, it is facing a lot of structural challenges, including a rapidly aging population. And when we look at India, it's a relatively young and a rising labor force and a far friendlier external environment domestically, as I would say. So we have been getting a lot of questions, can India be the next China? So in this report, what we did was we didn't simply say that whether India can grow rapidly over a long period of time and become as large or as rich as China today. I mean, at some point, this is not difficult to answer. With population as large as China, we are of the view that Indian economy at some point will become as big as China. But we try to give a framework on how India and China economic fortunes will pan out, especially in terms of manufacturing. Second is domestic market. And the third is as a implications for the global commodities and energy markets.
Okay. No, I have one follow-up. You said that, when you talk about a rapidly aging population in China, that's a big issue. And on the flip side, perhaps you're also looking at how a demographic dividend in India, right, is something that we could hit the peak at 2040. But there are a lot of naysayers who believe that from a demographic dividend, we could actually be staring at perhaps a demographic disaster because of the lack of jobs. At the rate at which the young population is growing and the rate of jobs is not matching up, we could be in for some trouble. Would that be something to consider in your thesis?
Okay, so let me connect with what we are trying to say and from a manufacturing point of view. So if you look at manufacturing, because that is one sector where we can create a lot of jobs, at this point, as of today, I don't see India is likely to pose any serious challenge to China's overall position. I mean, India's share in global manufacturing is 3%, China is about 30%. However, from here to next 5 years, 10 years point of view, we think India has a very potentially favorable conditions for rapid growth in manufacturing. So your abundant cheap labor, because the labor cost in India is for manufacturing is one of the lowest across EM, improving infrastructure, policies to attract foreign investment, and most importantly, is a very favorable international image right now, which India has in terms of the global audience. At the same time, I think one big quality which India has, which I don't see any other Asian economy can replicate at this point, where your demographics could actually be a boom, is a potentially a large domestic market. And when I compare India with China, we realize that India today is equivalent to China in 2006, 2007, while our per capita income is equivalent to China in 2000. And I think that will be one key for a rapid manufacturing growth in the years ahead. So I think that is something which I will see from a very potentially positive, favorable condition that could work for India in terms of a demographic dividend.
Okay. So India's domestic consumption is one factor which differentiates it from the rest of the emerging markets. You've also, in one of, as a part of your framework, you've also raised the question that will India's energy and commodity demand grow like China's did over the past 2 decades, and will it have the same impact on the global markets? Where do you stand on this, and what are the thoughts one should keep in mind?
So if you look at China's data over the last 2 decades and the way China has evolved as a part of the global manufacturing space, it has an enormous impact on global energy and commodities market, specifically over the past 2 decades. When I compare it with India, we are already a large oil importer. We are already seeing that the coal imports are also on the rise. But when I compare China and where India is, I don't see that India will see a very similar demand pattern what you saw in China in the last 2 decades. We need to realize that even our GDP compositions are very different. India is largely a services-driven economy with more than 50% share in services as a part of our GDP. Manufacturing share as of now is only 13%. So even if we expect that 13 goes to 25%, we don't see that the growth is unlikely will be as capital and energy intensive what you saw in the case of China. And at the same time, India's own resource availability and a different urbanization pattern also means that the country is unlikely to follow China's past part of imports of base metals, especially iron ore.
Economists also make forecasts, right? You all look far into the future, even though it's extremely hard to do that. So give us the numbers that you have in your mathematical model. You said India's share of manufacturing in the world is just about 3%, while China is at more than 30%. Now, how does that change, say, in the next 10 years? Do you have any number to that? And also, what can go wrong to this thesis? Because you spoke about many factors which are aiding it, favorable regulations, India's constantly upgrading its infrastructure, but there is also a possibility that China may, on the regulatory front, maybe change the game.
Absolutely. So if I look at from a base case, so 3% right now is India's global manufacturing share. We think it can clearly double over the next 1 decade. But there are a lot of risks which could hold back India from becoming the next China. And I think the first and the most important is infrastructure bottleneck, especially the last mile connectivity and a very unstable power supply. At the same time, while we have a very young population, labor productivity is another big concern. And the third will be the regulatory laggards. I think these are the 3 big, bottlenecks that India will definitely need to work upon to boost manufacturing. I mean, we are seeing some progress in land acquisition, even though it is slow, but it still continues to be a hindrance for large-scale infrastructure developments. India is working on reaching free trade agreements with several countries that could actually help in boosting export potential over the next 1 decade. So I would say there are a lot of leads, plus there are a lot of laggards, and we need a good balance on both that counts and a lot of policy intervention in helping India go to that part what China saw in the last 2 decades.
Okay, a lot of work needs to be done. Thanks a lot for joining in. I appreciate your time here on CNBC TV18. Let's slip into a quick break. On the other side, we'll get you more on the markets. Markets are doing very well at the moment. Hopefully, the trend will continue. More on that coming up.
Welcome back. The Nifty is back above 25,000. It was at 25,043 at about 10 o'clock. But after that, there was a little bit of a dip below that level, that key level that market participants are watching. And now we've managed to climb back above that. Some of the stocks which have moved in the last 10 minutes, Tata Consumer, Bajaj Finserv, Hindalco, HCL Tech, ONGC too is now up close to about 2.5%. So these are stocks which catch your attention. IT, of course, has done bulk of the heavy lifting today. The Nifty IT index itself is up 1.5%. And, you know, names like Wipro, HCL Tech are also inching up. In fact, there's a very interesting note which has come out, which is written by Jefferies on the IT sector, where they talk about Indian IT's outperformance. Now, Indian IT has been outperforming for the last 1.5 years now. The outperformance began in 2023, where the Nifty IT outperformed the Nifty by about 4 percentage points. The Nifty IT went up 24%, while the Nifty was up 20%. And that has continued in 2024 so far, with the Nifty IT index up 17%, while the Nifty is up 15%. So it's been about 18 months of outperformance, and this outperformance is despite earnings cut. So Jefferies has done analysis. If you look at the calendar year 2026 EPS estimates, except for TCS, for all the others, it's come down. And for some of them, it's as high, particularly on the mid-cap end, it's as high as 12 or 13% for Tech Mahindra, Coforge, LTI Mindtree. We're talking about EPS cuts of about 10 to 15%. So this up move that started, in 2023 for the IT names and accelerated and gathered steam in the last 3 months is largely led by PE re-rating. It's not led by earnings upgrades on hopes of a sharp growth recovery. So they say that the Nifty IT 16% year-to-date rally is driven by an 11% increase in the forward PE multiple. Also, there are now divergent trends between Indian IT companies and Accenture. So Indian IT is trading at a premium to its historical average, last 5-year average, which takes into account the COVID years and the bumper COVID years. But Accenture is now trading at a discount to Indian IT companies. So according to Jefferies, valuations today are rich. The Nifty IT is trading at 29 times multiple. It's a 40% premium to Nifty versus an average premium of 23%, making the valuations rich. And therefore, Jefferies would choose to be selective on the sector, and they would prefer Infosys and TCS because there are limited risks to earnings growth and there is relative valuation comfort. So this outperformance is driven purely on PE re-rating, and this is despite there having been earnings cuts.
Okay, well, moving on, Zydus Life is buzzing after Teva has got the US FDA approval for a generic drug used for ulcerative colitis. Ekta has more details on all of that. Ekta, over to you.
Well, yes, Zydus is in focus because Teva has received US FDA approval for Asacol HD, which is basically a drug which is used for ulcerative colitis. So they've received the approval for the generic version of it. Now, the likes of Jefferies has written on it. They said that the product accounted for 3 to 4% of Zydus's revenue and 8 to 10% of their EBITDA in FY24. They assume that the product contribution will drop to less than 1% of revenue for Zydus and less than 3% of EBITDA in FY26. The sharp decline in earnings from new entrants in Asacol HD has, however, reduced according to them because there are recent launches such as Mirabegron generic, which is useful for Zydus. It will be very beneficial for Zydus according to a lot of analysts, and increasing contribution from the cancer drug Revlimid generic. Additionally, Zydus is in focus because they're going to be buying 50% in Sterling Biotech for 550 crores. It's one of the leading producers of pharma gelatin. FY24 revenue 455 crores. Sterling Biotech, remember, was acquired under NCLT, but at that time the valuations were almost half of what it's valued at 100% level now. At around 1100 crores is what it's valued at. It was valued at over 600 crores when it was bought in NCLT. So the street is waiting to see whether it will be earnings accretive for Zydus and by when. Post-acquisition, Sterling Biotech will become a joint venture between the buyer, which is Zydus, as well as the seller, which is the private equity firms that had bought it under NCLT in 2022.
Thank you very much for that sharp cut in Zydus Life, down 5%. Let's also get you some index-related updates. Now, BEL and Trend will be entering the Nifty 50 from the 30th of September. The FTSE semi-annual index review will also come into effect from the 23rd of September. Vivek joins in with the details. Vivek.
Well, that's right. All through Friday, we had intimated to you about how exactly, the index constituents or the index subcommittee was meeting to go ahead and make changes as far as the various NSE indices were concerned, and we also hinted about which were the likely inclusions as well as exclusions. So largely in line with what the street was anticipating and what analysts had penciled in. Bharat Electronics and Trend have come into the Nifty at the expense of Divi's Labs and LTI Mindtree. These adjustments will take place on September 27th, and the changes will be effective from the next working day. So what could be the impact from passive funds on the back of this particular development? Number one, Bharat Electronics could see inflows of a little over $450 million, Trend inflows of over $640 million. Divi's Labs could see outflows of over $260 million, and LTI Mindtree could see outflows of over $220 million. Now coming to the Nifty Bank Index, again over here, Canara Bank has displaced Bandhan Bank. Canara Bank will see inflows of almost $79 million. Bandhan Bank will see outflows of almost $40 million. Now coming to FTSE, again, FTSE post-market hours on Friday went ahead and announced the semi-annual index review. With a lot of additions made from India, no deletions this time around. 13 additions to the FTSE all-world index. A lot of additions as far as the all-cap index is concerned. Talking about the all-world index, the rebalance will lead to net flows, inflows of almost $1 billion. Adjustments will be made on September 20th, 2024, effective September 23rd, 2024. Key names, almost 30 names coming in. Some of the key names and names that are buzzing today, look at names like Central Bank, Cochin Shipyard, Endurance Technologies, Escorts Cobalt are one name that's really buzzing today. Motilal Oswal Financial Services, expect to see inflows of almost $20 million over there. Additionally, like we mentioned, FTSE has announced almost 48 additions as far as the all-cap index is concerned. So a lot of inflows coming in, and India getting its weight higher in each of the passive indices, especially MSCI as well as FTSE.
Okay, thanks a lot for that, Vivek. Well, moving on to the latest on the newly approved Unified Pension Scheme. The government has clarified on the additional costs of the new scheme and has also reiterated the fiscal impact of the scheme. Sapna is here to tell us more on that. Sapna, over to you.
Yeah, hi. So, we have actually just spoken to the chairman of the pension panel that was there earlier, Mr. D.V. Somnathan, and he has very clearly reiterated that whatever is the additionality that the government is talking about in terms of the 6,250 odd crores plus 800 crores in terms of the earners, that's all inclusive in this 18.5% prospective contributions that the GOI will be doing for the next financial year onwards. Which means that, currently, whenever the NPS universe or the NPS employees under NPS shift to the UPS, that additional cost has already been factored into this 18.5% calculation. In a nutshell, that's what the government is trying to indicate, and they have reiterated this number. It was duly and amply explained on Saturday in the press briefing after the Union Cabinet had cleared the proposal. And the same is coming through Mr. Somnathan now. Going forward also, they are very clear that this is a one-time impact in the sense that this is the kind of cost that will be borne in the first year of the rollout of the UPS. And after that, there could be some changes depending on how many new employees come in and how the scheme actually pans out. So I'll just kind of give me a minute. So I'll just reiterate what he's actually told us. The 18.5% prospective contribution already includes the cost for existing staff who are within the NPS. The amount required for the earlier years for the staff already in the scheme is already factored into this 18.5% calculation. The fiscal impact in 1 year will be around 6,250 crores plus 800 crore arrears for those who are already retired in the past and who are not included in the 18.5% calculation. There will be no other cost or one-time impact apart from this.
Thank you very much for that. There are lots of pockets and themes doing well in the broader markets. So one of them is the entire brokerage theme. So Edelweiss Financial Services has a big gain going for itself. You also have GM Financial. Motilal Oswal on large volumes is up nearly 9%. So that's looking up. Honasa is a big mover on very large volumes. So Honasa is up nearly 12% today. Mid-cap IT, the names which catch your attention, it's Quick Heal, 14% up. Birla Soft, a 5.5% gain. Tata Elxsi has moved up 3%. Persistent, which has been such a rank outperformer, also continues to rally. Persistent Systems is up 95% in the last 1 year. And if you pull up a 3-year chart, a 2-year chart, you would see the kind of re-rating Persistent Systems has seen. And that stock continues to see buying. So IT is very strong. The advanced decline ratio is firmly skewed in favor of the stocks which are gaining today. We'll get into a break. We'll come back with more on the markets.
Welcome back to Trading Hour on CNBC-TV18. Well, in his much-awaited keynote address at the Fed's annual retreat in Jackson Hole, Fed Reserve Chair Jerome Powell said that it is time to adjust the policy rates. He added that the timing and pace of the rate cuts will depend on the incoming data, evolving outlook and balance of risks. CNBC's Steve Leesman joins us with the key highlights.
After 2.5 years of fighting inflation, Fed Chair Jay Powell took to the podium here at the Jackson Hole Annual Conference on Monetary Policy, and he laid down a new marker on policy, declaring now is the time to adjust policy downward.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
Powell suggested the Fed, with timely adjustments to policy, could stick that so-called soft landing, saying the Fed could get back to the 2% inflation target with a still strong job market. Those comments on the direction of policy and the outlook for a soft landing helped stocks and bonds. You can see the 2-year there fell. The dollar was weaker. All of that suggesting, like I just was saying to Dom, that maybe the market wasn't fully prepared for a really declarative statement about the direction of policy here that was maybe less hedged than people were thinking. Powell did not, however, specify the pace or the extent of rate cuts, though we did say multiple cuts were coming. So what do you watch now? Well, look for further job market weakness to determine, is that going to be a 25 or 50? Inflation does need to be continuing downward. I don't hear the Fed coming off of that 2% target, so it's still some work to do there. It's got to continue that. And you look for an economy around potential. Any weakness in the economy could make the Fed be more aggressive. Now,
Okay, as Fed Chair Powell said, we need to be careful of the employment side of the mandate, said the Chicago Fed President Austin Goolsbee. He adds that the inflation is on the path to 2%. Listen in.
I think the general notion that we want to be careful, as Chair Powell said, about the employment side of the mandate, too. We're not just fighting inflation now. Inflation's on a path to 2%. I totally agree with it. I still think, not just for this meeting, over the next calendar year, let's say, I think it's worth looking at the statement of economic projections that the committee has been putting out every 3 months. In those statements, there's widespread agreement that there will be multiple rate cuts over calendar years 24 and 25. Inflation would be coming down, and the unemployment rate would be creeping up a bit and settling in.
Okay, let's also listen into what market experts have to say about the Fed Chair Jerome Powell's speech and its impact on the overall U.S. market.
I liked the speech overall, and I think it reinforced messages that had been delivered that September is very much the time to look for the next move. I think at this stage the odds are much more towards 25. I know the market might be leaning a bit more towards 50, but this situation is not, getting out of hand. He observed that while unemployment has gone up, it is still at normal levels. So while he doesn't want to see it worsen, I don't think he feels the necessity to move dramatically. So I would suggest and expect a series of 25s as the most likely outcome at this stage.
Essentially, this was a valedictory of essentially Chair Powell turning the page, saying the mission, which has been focused on inflation for the last 2 years, has been successful and that we are there, and that going forward, the mission is going to be maximizing full employment. He doesn't want to see any further weakness. My base case scenario is that we are on a journey of 25 basis point cuts, probably for the next 8 meetings, a couple hundred basis points cumulative. So that's my base case. But if we see weaker growth, and particularly weaker jobs, then I think we could have a bit of front loading and start the process with 50 basis point cuts.
He likes to give straightforward discussions, and his Jackson Hole speeches have tended to be much shorter rather than much longer. And in the past, he made it clear they made inflation #1 priority. Now he has clear that worrying about the downside risk of the economy is his #1 priority. He didn't quite say the all clear on inflation, but came pretty close to saying that, and said that's why he's comfortable and starting to focus on the employment situation. I don't think they're going to start with 50. If they started with 50, that's kind of an admission that something went wrong, something's problematic. I mean, if the the employment report we get at the beginning of September is wildly disastrous, sure, but I don't think so. I think that they'll start gradually and then pick up pace if the labor market weakens.
Well, with that, it's a wrap on Trading Hour. We enjoyed the show. Thank you very much for watching. Stay tuned. Halftime Report is up next.